Ever wonder what really separates the winners in the stock market? I mean, beyond the noise, the tips, is there something more fundamental?
Yeah, something about how they actually see things, right? Not just the ticker symbols.
Exactly. So today on the deep dive, we're going headfirst into a classic, Reminiscences of a Stock Operator. We're looking for the surprising insights.
It's less about hot stock picks and more about getting the why behind the market's pulse.
Right. And for you, the learner, listening in, this book isn't some dense textbook.
No, not at all. It's actually a story, a fictionalized but very real look at Jesse Livermore's life. He was this legendary figure.
And the sources we're looking at today really zoom in on his early days, his formative experiences.
And they reveal these timeless ideas about market psychology, human behavior, stuff that's still incredibly relevant whether you trade actively or just want to understand the markets better.
Okay, let's get into it. We're not just summarizing. We want to pull out those actionable nuggets, those foundations Livermore built early on. Really understand that mindset.
Good plan. So where did it all start for him? His background.
Yeah, how did he even get into this world?
Yeah, it's fascinating, almost accidental. He finished grammar school, got a job as a quotation board boy. That's it.
A bored boy. So just writing numbers.
Pretty much. But right away, his knack for numbers was obvious. They say he did 3 years of arithmetic in 1 year at school. Mental math whiz.
Wow, 3 years in one. That's more than just being good. That's a real affinity.
Seems like it. So he's there, surrounded by this constant stream of numbers on the board.
And it wasn't just about money for him yet, was it? It was something else.
Exactly. He said they weren't dollars to him, they were just figures, changing figures. The constant movement fascinated him.
Not why they changed, just that they changed.
Right. That relentless change was his focus, day in, day out.
So he's watching this dance of numbers. And I hear his memory was pretty incredible.
Oh, definitely. He could remember past price movements, especially right before a big jump or fall. That let him start seeing patterns.
Patterns. Like history repeating itself in the numbers.
Yeah, he called them parallel cases. How stocks behaved similarly in upswings or downturns. These past actions became his guide, his mental dope sheets.
So even as a kid, basically, he's comparing today's action to yesterday's, looking for echoes, building this internal market database.
That's a great way to put it.
How did that translate into actual trading then, this observation phase?
Okay, so here's where it gets really interesting, especially for you, the learner. An older kid in the office gives him a tip, a dandy tip, on Burlington stock.
And Livermore thinks.
His first thought is, trading, that's for rich guys, big money. He had no idea you could, play with just $5.
In a bucket shop, right?
Yeah.
Which wasn't exactly the New York Stock Exchange.
Not even close.
Yeah.
Bucket shops were basically betting parlors on stock prices. No actual stocks changed hands. Risky, often shady.
But he could get in with $5.
Exactly. And he started winning, bringing home decent cash.
Which his mother must have loved. Or not.
Huh. Well, she was worried. Saw it as straight-up gambling. But he saw it differently.
How so?
He felt he was making money by figuring. It wasn't luck, in his mind. It was his calculations being right.
That's a key distinction, isn't it?
Yeah.
Gambling versus figuring. Especially for you, listening now, trying to grasp his mindset.
Absolutely. He genuinely believed if his analysis was right with 10 shares, it'd be 10 times as right with 100. Incredible confidence for a young guy.
So for him, bigger bets just meant amplifying his correctness.
Pretty much.
Yeah.
And that whole period highlights the difference he saw between random bets and calculated moves based on observation. But, those bucket shops were volatile.
Right. You mentioned bucket shop drives.
Yeah, they could wipe people out fast. And there were these operators who knew how to game the bucket shops, too. It wasn't a clean game.
So even with wins, he started to feel like something wasn't quite right with this approach.
Yeah, eventually. The wins were there, but it wasn't consistent. He called it getting one swat after another, just erratic results. Very. So around 22, he makes a move, leaves the bucket shops, goes to a proper brokerage office, Fullerton's.
Okay, that sounds like a big step up.
Yeah.
A real learning curve, I bet.
Huge. And this is where he really starts learning the difference between just betting on tiny wiggles in price
Which is what the bucket shops were about.
and anticipating the bigger, more inevitable market moves. That's the jump from gambling to actual speculation.
And his first day there wasn't exactly smooth sailing.
Oh, disaster. He got burned by the ticker lag. The tape showing the prices was way behind the actual prices on the floor.
Ouch. So he's trading on old news without realizing it.
Exactly. Made a big loss right away. A really harsh lesson after the instant quotes in the bucket shops.
That must have been a shock. What did he take away from that?
The big one was tape reading is not enough. You can't just react to the last print. You need a bigger picture.
Makes sense.
He also realized he hated trading with limits, setting specific buy or sell prices. He just wanted to act on his conviction, get in or out at the market price if he felt strongly about the direction.
So more about the overall move, less about squeezing pennies.
Right. Identifying the big swings became the goal, not just scalping tiny profits.
But learning this wasn't cheap, was it, that summer on the Jersey coast?
No, definitely not. He mentions trading actively, but his wins just didn't cover the losses and, well, living costs. It was refinement through costly experience.
A reminder for you, the learner, that even the greats hit rough patches. Learning costs something.
Absolutely. It wasn't just about making money. It was this deep dive into how markets actually work.
And then he runs into different ways of thinking about the market, like old turkey.
Ah, yes, Mr. Partridge, old turkey. Great character. He had this simple line he always used.
What was that?
Whenever people fretted about news or small dips, he'd just smile calmly and say, it's a bull market.
Sounds almost dismissive. Or overly simple.
Yeah. That's what Livermore thought at first. He was so caught up in the tick-by-tick action.
So what was the real wisdom there for our listener?
Old Turkey's point was about the big trend. In a bull market, the main direction is up. If you're constantly jumping in and out, trying to time every little wiggle,
You risk missing the main move,
yeah,
the big gains.
exactly. The lesson for you, the learner, is recognizing that dominant trend and having the discipline, the patience to stick with it.
Which was the total opposite of this other guy he mentions, Elmer Harwood.
Yeah, Harwood was all about tips. Couldn't understand why Turkey wouldn't just grab small profits. It really highlights that contrast. Short-term chasing versus riding the main trend.
So Turkey just held on, ignoring the noise. Powerful idea.
Mm.
Livermore also had that hunch about Union Pacific, right? Going against the grain.
He did. Sold it even though a friend was bullish and the stock initially ticked up, but his gut feeling, his analysis told him otherwise.
And it paid off.
Eventually, yeah, the stock dropped. It really boosted his confidence in his own judgment, his own reading of the situation.
It really seems like a core theme is him learning to trust himself over the crowd. Saratoga reinforced that.
Big time. Saratoga taught him the hard way. Don't trade on tips. Follow your own analysis of the basic conditions, as he called them.
Basic conditions,
Yeah.
meaning the bigger picture.
Yeah, moving beyond just the stock price to the underlying market health, the economic factors. This also led him to develop his pyramiding strategy.
Ah, pyramiding. How did that work?
It's about discipline. Start small. If the trade works, shows a profit, then add more. Don't just throw everything in at once.
So you're confirming your idea before you really load up. Makes sense. Reduces risk if you're wrong initially.
Precisely. You're using the market's money, essentially, to increase your bet, protecting your initial stake.
And the St. Paul Railroad situation was another example of him looking at that bigger picture.
Absolutely. He analyzed their financial struggles, needing cash when money was tight, and figured it signaled a broader market downturn was coming.
So reading the company's situation as a sign for the whole market.
Yes. Moving from just tape reading to analyzing fundamentals. And when the market did weaken, his conviction let him profit because he had anticipated it, not just reacted. It shows you, the learner, the power of understanding those underlying drivers.
He was really becoming more of a market strategist, not just a trader. What about the reading railroad?
Similar thing. He saw it as way overpriced, figured the pool supporting it was shaky, and competently went short, big time. And he was right.
And this leads into the panic of 1907.
Yeah, because he was already bearish, already anticipating trouble based on his analysis. He was positioned perfectly for the crash.
While everyone else was panicking.
Exactly. He profited hugely while the financial system was practically melting down, needing J.P. Morgan to step in. It just underscores, for you, the learner, how important it is to consider those big systemic risks.
Then there were the commodity trades, wheat and cotton. Different lessons there.
The wheat trade showed the importance of watching volume alongside price, seeing how much buying or selling pressure there really was.
And the cotton trade. That one sounds painful.
Oh, it was, especially for you, the learner. This is crucial. He traded cotton with Percy Thomas, someone he admired, but he let Thomas influence him, went against his own system.
What was the mistake?
Averaging down. Buying more of a losing position, hoping it'll come back. It's a classic trap. Violated his own rules and cost him dearly.
Wow. A huge lesson in sticking to your guns, sticking to your own system, no matter who tells you otherwise.
Absolutely. Don't let emotions or someone else's opinion override your discipline.
And finally, that consolidated stove story sounds like market manipulation 101.
It really gives you a peek behind the curtain, shows how news, tips, buzz can all be manufactured to help insiders unload stock onto the public.
So the takeaway for the learner there is,
Be incredibly skeptical of hype, positive news bursts, unsolicited tips. Ask yourself why this news is coming out now. Often it's part of someone else's plan to sell. Understanding that psychology is key.
okay, so boiling it all down for our listener, the learner, who wants practical knowledge, what are the absolute key actionable insights from Livermore's early days?
All right. Number one, you have to develop your own market understanding. Observe, analyze, don't just follow tips.
The independent.
Totally. Keep records, study past patterns like his mental dope sheets, know the difference between speculating calculated risks and just gambling.
Conviction matters.
Huge. Trust your analysis. Don't get shaken by every little market gyration or what everyone else is saying. Watch out for your own emotions. Hope and fear are killers. Discipline is everything.
Empty technically.
Understand those lines of least resistance, where prices are likely headed. And maybe the biggest, most painful lesson he learned: never average down on losers. Cut your losses quickly. It's vital.
Those are solid gold principles.
Yeah.
Timeless. It really sounds like his education was expensive, sometimes painful, but continuous.
Definitely. What you as a learner can really take from his behind the scenes is his willingness to learn from mistakes, even the big costly ones.
It wasn't instant genius.
Not at all. His philosophy grew over years of trial and error. He evolved from just watching the ticker to understanding the whole economic picture.
And that fierce independence.
Crucial. Resisting the noise, thinking for himself. His success came down to memory, constant observation, and rigorous analysis. Not luck, not secrets.
So it's a journey. A long process of learning, failing, adapting, refining.
Exactly. And that's the truth for anyone trying to understand these complex markets. It requires ongoing effort, learning, and self-awareness.
This has been fantastic. Diving into Livermore's early years really shows how lessons from a century ago are still so potent today.
It's amazing, isn't it? It's not just about market mechanics, it's about human psychology, how we react under pressure, financially and otherwise.
Absolutely. So for you, our listener, the learner, looking to learn quickly but deeply, remember Livermore's core lessons. Rely on your own analysis, understand the big picture, the underlying conditions, and guard against emotional decisions.
Which leads to a final thought for you to chew on. Livermore stressed independent observation. So, what hidden patterns, what subtle cues might you start noticing maybe in markets, maybe elsewhere in life, if you really committed to observing more closely, more analytically?
That's a great question to carry forward. If this deep dive sparked your interest, definitely check out the full Reminiscences of a Stock Operator. It's a compelling story about that continuous journey of learning in the markets. And as we saw, these early years were just the start for Livermore.